What is an adjustable rate mortgage? What are the pros and what are the cons? I'll be back in a moment with details. Hello, I'm Errol Wertz with Landmark Realty in Hays, Kansas, and I'd like to talk to you about adjustable rate mortgages. You're asking, what is an adjustable rate mortgage? Well, an adjustable rate mortgage loan is a loan that uses a changing interest rate based on the market after an initial fixed period. And there are various types of fixed periods. And some prefer the adjustable rate mortgage over a fixed rate mortgage, especially if you can't qualify for the fixed rate mortgage at the present interest rate. Adjustable rate mortgages are usually a point, sometimes maybe a point and a half below what the fixed rate mortgages are. So this is good for first-time home buyers or people who don't plan to live in the home for a long period of time, or for those people who have an employer that relocates them quite frequently. But the adjustable rate mortgage has a fixed rate for a certain period of time, and after that period the rate adjusts either on a yearly basis or every 6 months over the period of the loan, which could be a 30-year loan. Now, if it's a 5-1 adjustable rate mortgage, that means at the end of 5 years, you have a fixed rate for 5 years. At the end of 5 years, the rate will adjust in that 6th year. There are caps written into the loan agreement, and the cap is that the adjustment can't be above 2%. Most generally, they'll probably only go up a quarter to maybe 0.5%, but the cap is each time that the interest rate is changed, it can't go up more than 2%. Now, over the lifetime of the loan, which could be a 30-year mortgage, the cap is usually, depending on the lender, is usually 5% or 6%. So, if you started out with a adjustable rate mortgage today, say it was, well, 4 or 4.25%, then the maximum it would be 6%. That's the most that you'd pay if it was the maximum interest rate available at the time. Now, it's good for people who are first-time home buyers because they may not be able to qualify for a fixed rate at this present time, and it gives them the opportunity to get into a home at a lower interest rate. The adjustable rate mortgages come in, the fixed periods come in 5 years, 7 years, and 10 years, depending on the lender. And then you need to know whether it's a conforming or non-conforming adjustable rate mortgage. A conforming adjustable rate mortgage is one that is sold off to Freddie Mac and Fannie Mae, and the loan must meet those requirements of Freddie Mac and Fannie Mae. What they do is they combine all these mortgages together into a package, and they sell them off to an investor on the secondary market. Now, the non-conforming adjustable rate mortgages are mortgages that don't have to meet Freddie Mac and Fannie Mae requirements, and you need to make sure that you read the fine print very closely and that you understand the loan completely. FHA and VA do have the adjustable rate mortgages, and those mortgages are, of course, government-backed mortgages. The interest rate can vary. As I said, the maximum per year is 2%, and the lifetime of the loan, depending on the lender, is 5 to 6%. There are adjustable rate mortgages at 5-1, which means 5-year fixed. 7-1 would be 7 years fixed, and 10-1, which would be 10 years fixed. Now there can be a 5-6. The 5-6 means that at the end of 5 years, and every 6 months thereafter, the rate will be adjusted. The con of this is that if the interest rate goes up to a point that it really affects your budget and you can't afford to make the payment, you might be in jeopardy of losing your home. So you need to be very cautious if you're going to be getting an adjustable rate mortgage. But if you get close to that point where it's really going to affect your budget, but the fixed rate mortgage is something that you can handle at the time, you could refinance your home by getting into a fixed rate mortgage. By getting a new loan, you'd have to qualify just like you did for the adjustable rate mortgage. get a new loan, a fixed rate loan, pay off the adjustable rate mortgage, and then you'd have a fixed rate for the remainder of the term of your buying your home. So these are the options that are available if you're going to be purchasing a home. If you can't qualify for the fixed rate today, then why don't you look into an adjustable rate mortgage, and maybe that will help you to get into a home. Down payment wise, well, if it's an FHA loan, it'd be 3%. Some lenders are, for conventional loans, adjustable rate would be maybe a 6% down payment. But again, look into these if they would be an advantage to you and it would help you to get into a home. If this information was of interest to you and helped you in making a decision on whether you want to go forward in buying a home, please click the thumbs up button below. And of course, we invite you to subscribe to our channel. And of course, I'll be back next week with more information about living in Hays, Kansas.